morning, students. I'm Dr. Gauravi, Assistant Professor at Economics. Since in today's class, we are going to discuss about the types of investment. So initially, we will concentrate on the meaning of investment definition and what are the purpose of investment, types of investment. Then we will concentrate on the benefits of investment. Finally, we will give a summary regarding this investment. So we can make money through investment in three ways. One, this investment can lend money to someone on interest. Secondly, they can become a part owner of a business, like purchasing shares in a particular company. And lastly, by buying assets that tend to increase in value over time, such as real estate or bullion. The investment universe boils down to these three components, namely fixed income, equities, gold, and cash equivalents or money market instruments. Let us discuss on the meaning as well as definitions of investment. See, normally an investment is essentially it is an asset that is created with the intention of allowing money to grow. The wealth created can be used for a variety of objectives, such as meeting shortcomings in income, saving up for retirement, or fulfilling certain specific obligations, such as the repayment of loans, payment of tuition fees, as well as purchase of others. So understanding the investment definition is crucial as sometimes it can be difficult to choose the right instrument to fulfill your financial goals. Knowing the investment meaning in your particular financial situation will allow you to make the right choices. Investment may generate income for us in two ways. First way is if we invest in a saleable asset, we may earn income by way of profit. The second thing is if investment is made in a return generating plan, then we will earn an income through accumulation of gains. So in this sense, what is investment can be understood by saying that investments are all about putting our savings into assets or objects that become worth more than their initial worth or those that will help produce an income with time. Now let us concentrate on the purpose of investment. Financially speaking, an investment definition is an asset that is obtained with the intention of allowing it to appreciate in value over time. So generally, investment fall in any one of the basic categories. See, the first thing is to keep money safe. See, as far as this is concerned, capital preservation is one of the primary objectives of investments for people. Some investments help keep hard-earned money safe from being eroded with time. By parking your funds in these instruments or schemes, we can ensure that we do not outlive your savings. So fixed deposits or government bonds and even an ordinary saving account is very helpful to keep our money safe. So even though the return on investment may be lower here, the objective of capital preservation is easily touched. The second thing is to help money grow. So another one main objective of investing money is to ensure that it grows into a sizable corpus over time. A capital appreciation is generally a long-term goal that helps people secure their financial future. To make the money we can earn grow into wealth. So we need to consider investment objectives and options that offer a significant return on the initial amount invested. See, some of the best investments to achieve growth include real estate, both mutual funds, commodities, and equity. The risk associated with these options may be high, but the return is also generally significant. And the next thing is to earn a steady stream of income. The investment is also very helpful when we can earn a steady source of secondary income. See, examples of such investments include fixed deposits that pay out regular interest, or stock of companies that pay investors dividends consistently. Income generating investments is very helpful to pay for your day-to-day expenses after we have retired. So alternatively, we can also act as excellent sources of supplementary income during our working years by providing with additional money to meet outlays like college expenses. And the next thing is to minimize the burden of tax. Aside from capital growth or preservation, investors also have other compelling objectives for investment. So this motivation comes in the form of tax benefits offered by the Income Tax Act 1961. Investing in options such as unit-linked insurance plans, public provident fund, as well as equity-linked savings schemes can be deducted from our total income. So it has the effect of reducing our taxable income, thereby bringing down our tax liability. The next one is to save up for retirement. See, saving up for a retirement is very, very necessary, and because it is essential to have a retirement fund, we can fall back on our golden years, because we may not be able to continue working forever, right? Therefore, by investing the money we can earn during our working years in the right investment options, we can allow our funds to grow enough to sustain our after we have retired. Then the next one is to meet our financial goals. The investing is very helpful to achieve our short-term as well as long-term financial goals without too much stress or trouble. Some investment options, for example, come with short lock-in periods and high liquidity. These investments are ideal instruments to park our funds in if we wish to save up for short-term targets like funding home improvements or creating an emergency fund. The other investment options that come with the longer lock-in period are perfect for saving up for long-term goals. Now let us concentrate on the types of investment. See, investment generally fall into two types. One is growth-oriented investment, and the second one is a fixed income investment. If it is a growth-oriented investment option, means it aims at increasing the value of the capital over time. Whereas a fixed income investment option aims at providing a steady stream of income that can either be paid to the investors or reinvested while seeking to maintain a original value of the investment. So let us understand these different types of investment under two investment styles. One is mutual fund investment. First, let us concentrate on this mutual fund investment. These mutual funds are financial instruments that pool the money from various investors to invest in securities such as stocks, bonds, money market instruments, etc. Returns on mutual fund investments are based on the market performance of the fund's underlying assets. Investors can invest in mutual funds either through SIP, that is the systematic investment plan, or lump sum mode also. So according to the risk profile, investment horizon and financial goals, an investor can choose from different types of mutual funds available to them. Largely, there are 6 types of mutual funds, namely growth or equity funds, liquid or money market funds, fixed income or debt funds, hybrid or balanced funds, index funds, as well as tax saving funds. So, mutual funds help investing in achieving their financial goals to be short term or long term. The Indian markets that is SEBI has clearly defined each of these mutual funds categories to enable investors to make informed decisions. Next one is stocks. See, also it is also known as shares or equities. So stocks are among the most popular growth-oriented investments. See, when we purchase a share, we become part owner of a publicly traded company and stand to gain a part of the profits. The risk reward ratio with equity investments is often higher than most other forms of investment. Next, let us concentrate on bonds. Bonds are also known as fixed income securities. A bond is a debt instrument that represents a loan given by an investor to a company or a government. When we buy a bond, we allow the bond issuer to issue a fixed interest rate in exchange for usual our capital. Next, let us concentrate on the exchange traded funds. The exchange traded funds are the collection of investments such as shares, bonds, money market instruments that track an underlying index. They are a mashup of different investment avenues that offer a best attributes of two assets, that is mutual funds as well as stocks. As far as these exchange traded funds are traded on the stock exchanges are quite like mutual funds in terms of their regulation, structure, and management. So, however, one of the main differences between these exchange traded funds and mutual funds is that the former can be actively traded on the bourses at any given time during the day, which allows the investors to take advantage of real-time price differentials. On the contrary, mutual funds, whether active or passive, can only be bought or sold at the close of the trading day. Then let us concentrate on the fixed deposits. The bank fixed deposits are among the safest investment options available to investors. They are offered by banks and other non-banking financial corporations and allow investors to park their idle cash for a specific duration and for a fixed rate of interest. The interest rate is pre-decided and unaffected by market fluctuations, which ensures greater safety of the investments. From the ease of flexibility to various options offered to an investor, fixed deposits are a boon to risk-averse investors. Let us concentrate on the retirement planning. Saving for retirement as well as managing the income once we retire are two of the most critical aspects of the financial planning. There are several types of retirement plans available to investors. Some of the most common investment options for retirement planning are Senior Citizens Savings Scheme, National Pension Scheme, Public Provident Fund, Bank Fixed Deposits. And investors looking to save for retirement might consider opting for safer investment avenues if they are nearing their retirement. Cash and cash equivalents. cash equivalents strive to protect an investor's original investment while also offering high liquidity. However, they tend to offer the lowest potential returns than other investment types. While they do not generally offer capital growth, they have the potential to deliver regular returns. They can also play an important role in protecting our capital and reducing the risk of our investment portfolio to a great extent. Examples of cash equivalents include time deposits, overnight funds, liquid funds, high interest saving accounts as well as bank accounts. Then we concentrate on the real estate investment. The real estate sector holds huge prospects for several industries such as hospitality, retail, commercial housing, manufacturing, and much more. Investors have the option to invest in commercial or residential properties or even real estate mutual funds to earn significant returns on their investment. Timing is a crucial aspect when one considers investing in real estate. One should be mindful that real estate investment can be highly illiquid, that is, it might get challenging to get the property quickly in the case of an urgent monetary requirement. Now let us concentrate on the benefits of investment. So the main benefit of investment is we can reach our financial goals very easily with the help of this investment. At the same time, we can beat the inflation, and finally, we can earn significant returns with the help of this investment. So investment is an asset or item accrued with the goal of generating income or remuneration. In an economic outlook, an investment is the purchase of goods that are not consumed today but are used in the future to generate wealth. So in finance, an investment is a financial asset bought with the idea that the asset will provide income further or will later be sold at a higher cost price for a profit. So investment is defined as an addition to the stockpile of physical asset like machinery, building or road. So anything that sums up to the future productive ability of the economy and changes in the catalog of a manufacturer, that is considered as a investment normally. So these are the important aspects in regarding the investment. Thank you, students.